From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, July 11th, 2025. Taking a look at the calendar, the Brewers host the Nationals all weekend at AmFam Field. Still feels weird to call it that. And we've got a weekend full of rumbles at the annual Harley-Davidson Homecoming down at Veterans Park. Make sure you keep an eye out for all the motorcycles on the road this weekend. A zoo in Duluth, Minnesota recently made headlines when one of its residents, an 800-pound brown bear named Tundra, was fitted with the world's largest crown. And no, we're not talking about the kind that a king wears on his head. The zoo reports that Tundra is doing just fine after his hour-long dental procedure. A Connecticut man needed rescue after getting stuck in a chimney. The man became stuck when attempting to retrieve his dog from a park building restroom that had become locked. It's not known how the dog got locked in there or why the man thought the chimney was the best way to get in. What we do know was that there were no milk and cookies waiting for this wannabe Santa at the bottom, only criminal charges. Snakes on a plane. And no, this is not a Samuel L. Jackson movie. A flight in Australia was recently delayed after crews found an unwanted passenger hiding in the cargo hold. Turned out to be a harmless tree snake, but given that just about everything in Australia is trying to kill you, just can't be too careful. And our funny headline of the week. Blueberry spill causes literal traffic jam in British Columbia. Around the table today, we've got Adam Baley, Kendall Bauer, Joel Dresang, and looking back at the week, here's Kyle Tetting.
Well, thanks, Jason. Back and forth week for markets overall, but finishing down on the week, NASDAQ down 0.1%. That's down 16 points. The S&P 500 down 0.3%, 20 points down on the week, closing at 62.60 on Friday. And the Dow Jones Industrial Average lost 1%, falling 279 points on Friday, down 457 for the week. Closing at the bell on Friday in New York at 44,372 for the year. NASDAQ still up 7.1, the S&P up 7.2, including dividends, and the Dow Jones Industrial Average up 5.3. You know, Adam, I think pretty difficult to be upset about a little bit of a down week, given the recent run higher we've had. Stock markets broadly still trading near all-time highs. But it does seem like at least some of the conversation around tariffs is starting to creep back into investors' feelings. We've gotten a lot of kind of at least initial headlines on what that looks like. But, I think we've talked for a long time about how we needed to be a little more cognizant of what could come and be a little less complacent. And again, I think maybe that's what we're seeing this week is investors starting to come around to the idea that it isn't all going to be roses the way it has been the last few weeks.
I would, however, say there is still some complacency in the market. You certainly got the sense and the feeling later this week after we had some substantial tariff news and announcements. President announced that we're going to have a 50% tariff on Brazilian goods, maybe starting here in just a few weeks. Also, as of this morning, perhaps a 35% tariff on Canadian goods. And those could be substantial. I mean, for what it's worth, from Brazil, we import about $9 billion worth of oil and gas and petroleum products, another $5 billion in iron and steel and just raw materials, $3 billion of construction stuff, and a whole lot of food products like food, coffee, grain, meat, fruits, and vegetables. And you can even say more of that for Canada. My goodness, we import $131 billion of oil and gas materials from Canada, $50 billion worth of vehicles, $30 billion of just machinery, and many billions of just raw materials across the board. And you put a tariff on that, I mean, we're a billion here, a billion there. At some point, we're talking real money. And there has been a lot of complacency in the market. And I think investors, in part because it's been a lot of whiplash that we've had this year, this on-again, off-again theme. But at some point, it seems like these are going to stick.
And, of course, we have some time before those bills come due. August 1st seems like the deadline for at least a good chunk of that. There's still a lot of conversation, especially with respect to Canada, on carve-outs, similar for Mexico. I think if you're Brazil, and especially given some of the headlines around what seems to be the sticking point, okay, you're not treating your former president all that nicely, and we'd like to see you treat that president more nicely. Well, what's that have to do with foreign trade? I think a lot is getting lost right now in this conversation, and I'll be interested to see if we can maybe focus a little more, because as investors, what we want is not all of that noise, but we want some more clarity on what are we doing, why are we doing it, and when should we expect it? And so, I think very much, Adam, the question is, okay, what's the impact going to be for stocks? And we know that tariffs, the way they were originally announced, were likely to have a pretty significant impact potentially on corporate earnings, while we've maintained some pretty rosy outlooks for earnings. That's part of what I think has supported these higher prices. But if those tariffs, now that we're starting to see what it actually might look like, make their way into the economy, make their way into corporations' profitability more broadly, well, all of a sudden, now we've got to reassess what are we willing to pay for those stocks.
Yeah, and a lot of this is still yet to be seen on how businesses are going to handle this. But corporations essentially have like three paths forward. Either one, they absorb the tariff, or two, they pass it on, or three is kind of like a combination of both. And if you have businesses out there saying, you know what, we are going to absorb the tariff, we're not going to pass it on to our customers, essentially what they are saying is we will be less profitable. We will have less earnings. Our company will be worth less than it is. I mean, that is essentially the message that they would be giving. The other way is that they can say, you know what, we still need to be profitable because this is a for-profit corporation, and we will have to pass some of it on to customers. And Americans are just going to have to get then more comfortable with paying higher prices wherever they might be. But those really are the two paths forward for businesses. When tariffs really start to hit the shelves. And August 1st really is kind of the first date that we have, at least as it relates to Brazil and Canada.
How much of the complacency is the sense of, Adam, you talked about on again, off again, that there's an anticipation that it's going to be off again? And, the first foray into this was in April, and it was kicking the can down the road to July 9th, which we just passed, and now it's August 1st, which is a little sooner, but do you think that there's a lot of anticipation that that's going to be changed too?
I think it's a possibility, right? We went through this in April and May, and we saw how it played out, and maybe that's what we're up against. I think that's what makes it, in my opinion, so difficult to try to not just time markets, but to quote unquote get cute with your investing at this point. I mean, I think this year speaks so loudly to the balanced approach, not to completely toot our own horn here, but I mean, how else do you build and manage a risk-averse portfolio in an environment where, Adam, to your point, some of the tariff numbers that were announced are pretty serious, but we also live in a world that we could get done with this podcast episode and one tweet, they could be, non-existent.
Point well taken.
Yeah, it's interesting. I think for me, it was interesting to see how the market reacted this week. I frankly thought maybe it would have been beaten up a little more, so maybe there's some positivity to take away. But, Joel, I think it all goes back to how do you plan for the uncertainty? And it's, our viewpoint has largely been you try to focus on risk and plan for that stuff, this type of market in advance, and that's what can, get you through it and maybe let you sleep a little bit better.
Yeah, I think that's such a good point, is you cannot, predict the unpredictable or the uncertainty, but you as sure as heck can plan for it and do some common sense, practical, pragmatic things in your investment accounts, like one, adhering to balance, two, raising cash at all-time highs for future distributions, or just doing some practical rebalancing after letting your winners run for the past few years. Those are just some practical, pragmatic things to do in your investment accounts these days.
And things that we're doing every day for investors, right? The conversations that we have to have on a regular basis, not because they're calling us and saying, what are you going to do different, but because we're looking at portfolios and going, well, okay, what's new for you? What's unique for you as an investor? Because again, we can have this wonderful idea about here's how everything is going to shape up, here's what's going to happen, when it's going to happen, and what it'll mean for markets. But if that doesn't align with what you as an investor need, which is something that we as advisors have to understand, well, who cares what my thoughts are? Who cares what my opinion is? Who cares what we assume is going to happen? If that's not what you need, then we got to have a different conversation. And so I think so much of this is, first and foremost, what do you as the investor need? And then let's overlay all the other pieces of that to make sure that we're providing for whatever it is the need is first. Kendall, a big part of the conversation is always around all this new product that seems to be created to fill need. And I've gotten a lot of questions over the years on whether we should be buying mutual funds or exchange-traded funds, whether we should buy the individual bond or the individual stock, or whether there's some package, some version of it that makes more sense. And there was a really good article, I think today in the Wall Street Journal, talking about some of the new product creation, and I think potentially how we have to be careful when we're chasing some of that new stuff to make sure that it fits with who we are as investors.
Yeah, great article in the Wall Street Journal from Jason Zweig about that exact thing, and really kind of pointing out how index investing, which was once seen as kind of that, safe, passive approach where you're buying an index or the total stock market versus stock picking, has changed over the past couple of decades. Number one, with concentration, we've all heard of the Magnificent Seven, but the amount of weight they now carry in something like the S&P. And then we're in an environment now where there's new investment products. Active ETFs are kind of one of the hot topic things that are being introduced to the markets more and more consistently, and the different risks that come along with new products. So I think the big takeaway is know what you're investing in, but you got to be careful, because just because you take 3 or 4 super aggressive stocks and you package them into an ETF or a mutual fund doesn't mean it's less risky. There's a ton of positives with new products. You can buy certain sections of the market, and for certain investors, maybe that's great to have a sleeve in defense companies or in technology or information services. But you're also seeing products that are ramping up speculation, ramping up risk. There's things like single stock ETFs. There's a very small sliver of investors who that makes sense for. And some of these products are using margin. So they're buying a single company and leveraging it. So if the stock's down 10% and you own that, it could be down 2, 3, 4 times that. And so the big takeaway is, with any new introduction of new investments, new products, it's just about understanding what you own. I think for me is the biggest takeaway, and just be careful chasing returns by taking on extraordinary amounts of risk.
Kendall, you touched on active versus passive. And I wanted to take a moment and maybe just expand on that a little bit and understand why it's not one or the other, but really it is both. So by the way, passive investing, it's essentially, there's nobody at the helm picking and choosing what goes in the index. You get all the good companies and you get all the dogs. There's nobody at the helm deciding who goes in there. However, active management is a bit different. There is somebody at the helm who decides what goes in there and what doesn't. And, maybe the manager of that actively managed fund is saying, these businesses over here, they're vulnerable, but the ones over here, these are profitable. And when you focus on the profitable and avoid the vulnerable, that lends itself well, when done correctly, to better returns for less risk. So you can have some passive indexes for broad diversification and minuscule expenses, but it really needs to be paired with some actively managed funds. It's never one or the other. It's how can you use both to meet your objectives.
What I think is so interesting about this conversation is that those versions, passive versus active, or single stock versus broadly diversified, they exist in a lot of different wrappers. The underlying investment, the underlying, we'll call it a piece of candy, the underlying piece of candy tastes the same. It looks the same. It feels the same. But you've got these different versions of the same thing simply because we can put a different wrapper around it. And so the question is a little misleading, right? Should I buy the mutual fund? Should I buy the ETF? Yeah, maybe there are some reasons why one or the other makes sense. But I think what you're both getting at is that it's less important which wrapper you buy, and it's more important that you like the underlying candy. It's more important that it fits with what you're trying to do. It's more important that you actually understand, here's what it is I'm buying. I'm allergic to nuts, and I just bought that candy bar full of chocolate and nuts, well, okay, maybe that wasn't the right thing for you. It doesn't matter that the wrapper was pretty and that, you love the way it looked. And so I think that, to me, is one of the things that becomes so critically important is forget all the shiny bells and whistles, forget all the marketing around it. Really, let's get down to the core of what is this and how does it work for what we're trying to do. Joel, not a ton of economic data this week. We look back, we didn't have obvious updates from last week, but what stands out to you in terms of what we've seen over the last couple of weeks on the economy?
Yeah, Kyle, the big number this week was the revolving consumer credit outstanding that the Federal Reserve puts out once a month. That's showing us, it's basically showing us credit card debt. And it's a measure of consumer confidence, basically. If people are wanting to spend money, they're going to not pay off their debt as fast. They're going to be using their credit card more. And another reminder that consumer spending counts for about 2/3, almost 70% of our gross domestic product, our economic output. And in May, we got numbers showing that for the second time in 3 months, the fourth time in 7 months, that debt actually was going down. So consumers were showing, less confidence in continuing to spend. So that raises a question, and it's on the heels of, if you remember, a couple of weeks ago, we came out with the first quarter, the final first quarter number on that GDP, on gross domestic product, and it showed consumer spending was actually the slowest it's been since when the COVID pandemic started. So it's 5 years now. So there should be some concern there that consumers aren't going to be spending as much, and that's going to affect economic growth. Although we also, put it within the context of we've got extraordinary things going on. People were anticipating prices going up because of tariffs, and so they were stockpiling things before they needed them. And so we don't know. We'll have to wait a while to see how that all turns out. But last week we had some important numbers on things like unemployment, and that's still looking pretty good. We added jobs for the 54th month in a row. That's pretty good. The unemployment rate went down to 4.1%. It's been between 4% and 4.2%, I think, now for 13 months. That's pretty good. But there were other things too. There were numbers of the job turnover numbers were showing that the number of people quitting their jobs, which is a sign of worker confidence, that's been below where it was before COVID. It's been below that now for 17 months in a row. I always look at the number of temporary workers hired, because that's usually a harbinger of hiring trends, and that's been below the pre-COVID number now for 24 months in a row, so 2 years. So there are some concerns there, but mostly these numbers are showing a relatively strong economy that's maybe slowing down.
An economy that is still strong enough.
Yes.
That we don't need to overreact to a couple of data points that show slowing, because the economy more broadly is still on pretty solid foundation.
And it feeds into the Fed script of saying we've got to wait and see here. We are concerned about interest rates going up. We're concerned about unemployment going up. We're concerned about inflation going up and unemployment going up. And so we're just kind of waiting to see if one of those happens, to see whether we're going to continue to lower rates or to raise them.
And I think we're in the middle of a Fed that seems to be under some pretty significant pressure to do something. And I think this is our weekly reminder that the Fed is doing what they're congressionally mandated to do, which is respond to the data, to navigate the inflationary pressures that are still out there without having an undue impact on higher unemployment rates. And so full employment, stable prices, the Fed's dual mandate, and that's where we are. And it speaks to a Fed that probably doesn't need to take quite the outsized steps that maybe some of the outside pressure that's being exerted on them would suggest. At the same time, they do have to be cognizant of not just where are we, but where are we headed. And so I don't envy Jay Powell and the Fed. I certainly don't envy them when you add in all the pressure that's coming from outside sources. But to be clear, they're doing what they're supposed to be doing.
And Kyle, speaking of stable prices, just a reminder that the price for a postage stamp goes up to 78 cents on Sunday. That's from 71 cents, so it's like a 3.8% increase, which is greater than the inflation rate right now. And I did a little looking and math. So when the Forever stamp came out in 2007, it was 41 cents. So that's going to be a 90% increase in that time.
Pretty good return on investment. I think the S&P's still done far better over that time period, but certainly a decent opportunity if you were smart enough to buy those Forever stamps then in any significant
You can still
quantity.
rush out and get a bunch on Saturday if you're hearing this
at the
time.
lower price, yeah. Maybe the last piece this week is just a reminder that on the 4th of July, the president signed the big, beautiful bill. I think the operative word is big. It certainly is robust. There certainly is plenty to digest. And I think most importantly, even though we know the provisions now, implementation is key. That you're talking about a lot of moving pieces from a filing perspective for tax filers. You're talking about a lot of moving pieces from a how do we implement. And so as we learn more, we'll certainly communicate more. But, Adam, I think as you look at what's been written so far, as you look at what was in the bill, anything in particular stand out to you that's worth communicating with our clients?
Two things. One is expanding some of the benefits for 529s. What you can use them for, more contributions, just more usability for 529s. I really appreciated that, especially for 3 kids where I'm saving in their 529s for my own household. I like seeing that. The other piece, and perhaps the biggest piece, is just finally certainty and clarity on tax brackets going forward. I think that's going to add to just a lot of clarity for taxpayers in the years to come.
And Kendall, more children in your house so you can take advantage of these Trump accounts?
Yep. That's another key thing. The Trump account, although remains to be seen what exactly it is, how it's going to look, but an interesting concept to follow. And again, we'll pass along more as we learn more. But I think another meaningful part of this, too, not to overlook it, is the deduction for Social Security. So that's something that affects a lot of our clients, something that gets brought into some of our planning meetings for long-term retirement planning, financial planning. So that, I think, another piece of this that is going to certainly affect clients that we work with day to day.
Yeah, I think the billing was always that there would be no tax on Social Security. That's not quite how it's shaken out. I don't know that I necessarily blame anyone for maybe the miscommunication there, but the process with which this bill was written really didn't allow the ability to exclude tax on Social Security. And so, you are kind of stuck within the restrictions of the reconciliation process when you're writing this bill. There are very clearly some, I think, misses in terms of how that no tax on Social Security is going to work out. You're over $150,000 in income. You've really phased out the ability to take that $6,000 deduction. Beyond that, there's a lot of kind of quirks and nuances that we'll learn more about. But it certainly is a step in the right direction, especially for seniors kind of in those middle income brackets, to see a potentially meaningful benefit from keeping more of your income perspective. The other one I've seen written a lot about is this no tax on overtime, no tax on tips up to certain thresholds. And we really don't have any clarity still on even what occupations will qualify. It is going to be driven by occupation, especially on the tip side. It's up to the Treasury to kind of decide. And so I think, if anything, the point here is that while there are a lot of pieces to digest still, we really don't even know how a lot of it's going to shake out. We don't know where it's going to show up on filings. We don't really have clarity on that just yet, because it relies not just on the budget process, but it also relies now on all the offices that have to figure out, okay, how do we implement this change? And so a lot of things still to work out. I think we'll have more communication as we learn more. And then, most importantly, some of these pieces set to sunset going into 2028, 2029. And so we'll have some more communication down the road on, okay, here's what's going to be different going forward. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.